Welcome to my channel. If you've been glancing at your portfolio or your property documents lately and maybe feeling a little knot of unease about the new tax laws, I want you to take a deep, slow breath. You are in exactly the right place. Today's explainer is all about demystifying the Income Tax Act 2025 and specifically what it actually means for your capital gains. We are going to walk through this whole thing step by step together, keeping it sweet and simple so you can take total control of your financial planning without any of that unnecessary stress. So let's address the elephant in the room right off the bat. Did the new Tax Act wipe out your capital gains exemptions? I know so many taxpayers are dealing with some immense anxiety regarding this transition to the 2025 Act. You might be sitting there wondering if your hard-earned property exemptions just vanished into thin air overnight. Well, if you're feeling exposed right now, or you're thinking about pausing your investment decisions out of fear, listen closely. The absolute best news I can give you is that panicking is literally the single biggest mistake you can make right now. Here is our quick roadmap for today. 1. The new 2025 tax reality. 2. From Section 54 to 82. 3. The CGAS lifeline explained. 4. The Section 536 transition trap. And 5. Avoiding automated tax notices. Okay, let's jump straight into Section 1, the new 2025 tax reality. Before we get bogged down in the numbers, I really want to reassure you about something. Yes, the old Income Tax Act of 1961, the one we've lived with for over 6 decades, is gone. But the new 2025 Act, it's fundamentally just a massive reorganization. It was designed for simplification, basically to clean up hundreds of messy cross-references. It is absolutely not a brand new tax burden secretly designed to strip away your exemptions. Take domestic equity long-term capital gains, or LTG, for example. The reality is now a flat 12.5% tax rate for equity assets held over 12 months, along with a 1.25 lakh rupee annual exemption. So rather than sitting on the sidelines hoping for some magic tax relief that isn't coming, smart investors should really appreciate this structural certainty. We finally have a clear, predictable baseline for our financial planning. And honestly, that is way more valuable than dealing with crazy mid-year policy shifts. Moving right along to Section 2, from Section 54 to 82 and how it impacts your property exemptions. If you've recently sold a house or you're planning to, you really need to understand how the rules bridge the gap between that old 1961 legislation and our shiny new 2025 framework. Now, if you are familiar with the classic old Section 54 property exemption, where you save tax by reinvesting your capital gains into another residential house, well, that exact same rule is now simply called Section 82 under the new Act. That's it. The core math, the benefits, the entire tax relief framework remains perfectly intact. The concept is completely familiar. Literally, just the section number has changed. But the absolutely crucial element here is timing. The statutory reinvestment windows, that ticking clock we all know and stress about, are exactly the same under the new Section 82. After your sale date, you still have exactly 2 years to purchase a new residential house or 3 years to construct one. The law is definitely structured to give you relief, but you must strictly respect these time limits. Which brings us nicely to Section 3, the CGAS lifeline explained. So what happens if that clock is ticking down? Tax filing season is looming right over you, and you just haven't found that perfect new house yet. Well, there has been this massive, terrifying misconception floating around that the Capital Gains Account Scheme, or CGAS, was completely abolished under the new Act. I am here to tell you that is totally false. CGAS remains your ultimate financial lifeline. It allows you to preserve your capital gains exemption by depositing those unutilized funds with an authorized bank right before your ITR due date. CGAS is continuing robustly under the new administrative guidelines, specifically via notification number 161 of 2025. It's still right here to keep your exemptions safe while you hunt for that new property. And, just as CGAS protects your property exemptions, staying informed is what protects your entire financial future. If you are finding this breakdown helpful, and maybe it's easing some of that tax anxiety, please like, share, and subscribe to this channel. It seriously helps us continue bringing you these clear, deep dives into complex tax topics. All right, let's get into Section 4, the Section 536 transition trap. This is a big one. Let's look at exactly how the math works if you actually fail to utilize your funds within that 3-year limit. Imagine scenario A. You sold a property under the old Act back in June 2024 with a 40 lakh rupee gain, and you safely deposited it into CGAS. But if June 2027 rolls around and you still haven't built that house, your 3-year limit officially expires. Now, contrast that with scenario B, which is a sale purely under the new 2025 Act. In both of these cases, if you default, that 40 lock loses its exemption entirely and becomes fully taxable. But how it gets taxed during this weird transition period, that is where a very serious trap lies. Here is the Section 536 trap laid completely bare for you. If you deposited money into CGAS years ago under the old act, those specific deposits are still governed by the old conditions. However, if your 3-year clock runs out after April 1st, 2026, which is when the new act is fully active, the tax penalty is triggered under the new regime. It's a bit of a hybrid situation. The tax authorities will actually look back and evaluate your breach using the old 1961 rules, but they will officially charge and collect the tax under the provisions of the new 2025 Act in the year of your default. So please, do not assume your tax files are permanently closed and untouchable just because you deposited that money years ago. And finally, Section 5, avoiding automated tax notices. Let's make sure your returns are bulletproof. To bulletproof your returns, first up for our property sellers out there, for assessment year 2026-27, the Schedule Capital Gains in your ITR forms has made comprehensive buyer reporting strictly mandatory. You literally must provide the buyer's name, their PAN or Aadhaar, the full property address including the zip code, and the exact dates of the transaction. Missing even one of these newly mandatory details is a massive, immediate trigger for an automated tax notice. So go gather this data from your sale deeds right now. Don't wait on this. Now, for our equity investors, getting a tax notice is rarely about intentional evasion. It is almost always just a simple, silly mismatch. If the capital gains reported on your broker's trade ledger don't perfectly match the government's annual information statement, the AIS, the computer system is going to flag it automatically. It's that simple. To avoid this headache entirely, just follow these 4 simple steps. 1. Download your consolidated broker statement. 2. Access your AIS on the income tax portal. 3. Meticulously match the sale and acquisition data. And 4. Only then, go ahead and file your accurate ITR. Oh, and actually, I have some fantastic news to make this whole thing easier for you. For assessment year 2026-27, that incredibly tedious script-wise share-by-share disclosure is no longer required for routine long-term capital gains, unless your shares fall under those specific 2018 grandfathering provisions. That is going to significantly simplify your filing process. As we wrap up today's explainer, I want you to remember something important. Understanding these transitions from Section 54 to 82, respecting those strict CGS timelines, and carefully reconciling your data, it isn't just about blindly following rules. It's about actively protecting your hard-earned wealth. Tax compliance is your financial fortress. Subscribe to Tax TV English to get these guides almost daily, and keep your notices to 0.